Welcome back, everyone. SCHD is one of the most popular dividend ETFs on the market. But let me tell you what's even better than SCHD. It's having your own personal dividend ETF that is custom built just for you. How do you get one of these funds? Well, you build it yourself, of course, and that is exactly what I did. I built my own SCHD, borrowing the methodology of the fund's underlying index and tailoring it to my own personal style of investing. It's called the Factor Dividend Growth strategy. Before I explain how it works and how simple this was to create, let me tell you how this little project has worked out thus far. I launched this portfolio on November 1st, 2022, so it's been live for a little more than a year. Since launch, this portfolio is up 35.31%, while during the same span of time, SCHD has returned just 7.91%. I know SCHD had a rough last 12 months, struggling to yield positive returns. Meanwhile, the stock market had a pretty strong year. So let's see how my portfolio stacked up against the S&P 500. As I mentioned a moment ago, since November 1st, 2022, my portfolio has returned 35.31%, while the S&P has returned 25.66%. So my strategy is beating the S&P by 9.65% and SCHD by a whopping 27.4%. I call this portfolio the Factor Dividend Growth strategy because it's based on 4 financial metrics that I use to select the best dividend growth stocks. The strategy has one key principle in mind: quality. I favor business quality over any other metric when it comes to investing. I like to invest in the highest quality businesses with strong track records of financial growth, and I believe this is the main reason why this strategy has achieved the results that it has, and that it will continue to deliver strong returns. I know that I only have 14 months of results thus far, and this strategy could fall flat on its face at any time. But let me tell you how it works, and why I believe it has the potential to continue working, and you can decide for yourself whether you agree with me or not. Let's start with a quick rundown of how SCHD works, and how it inspired the Factor strategy. SCHD tracks the Dow Jones US Dividend 100 Index, and if we want to know exactly how SCHD works, we need to look under the hood of its underlying index. The Dow Jones US Dividend 100 Index uses a rules-based approach to select the 100 best dividend stocks for inclusion in the index each year. It starts with a universe of about 3,000 dividend-paying stocks, and narrows this list down to just the top 100. A key step in this narrowing process is the final ranking. To do this, the index uses 4 financial metrics, and this is where the inspiration for my strategy originated, as well as the name. I borrowed these 4 financial metrics with a few adjustments, and I applied them to a more tailored universe of dividend stocks that better fit my investing style. If you want to know exactly how the Dow Jones US Dividend 100 Index works, I'll leave a link to it in the description below. What I'm going to focus on instead is my own Factor strategy. The first step is to come up with an investable universe of dividend stocks that is made up of high-quality companies. I do this by running a stock screener to search for companies that meet the following 8 criteria: a payout ratio of 80% or less, a 3 and 5 year dividend growth rate of at least 5%, a 5-year revenue growth rate of at least 5%, a 5-year earnings per share growth rate of at least 5%. The stock must trade on the New York Stock Exchange or the Nasdaq. It must have a wide or narrow moat rating from Morningstar, and it must have an exemplary or standard stewardship rating also from Morningstar. Typically, when I run this screener, it spits out about 130 unique dividend stocks. These 130 companies are potentially better businesses to invest in compared to the entire universe of dividend stocks, because they have a history of growth, a commitment to paying and increasing dividends, a strong management team, and some type of economic moat. Because 130 stocks is too many for me to invest in, there is a second step in the strategy that helps me identify the 20 best stocks amongst this already narrow investable universe. The second step leverages the 4 financial metrics that I borrowed and modified from SCHD's underlying index. I take all of the stocks from my screener and I pull data for each of the following 4 financial metrics: the free cash flow to total debt ratio, the 5-year dividend growth rate, the return on capital, and the forward dividend yield. Next, I use these metrics to rank all of the stocks, and the goal is to find the stocks that rank the best across all 4 metrics. The premise is that I'm looking for financially strong companies with a history of above-average dividend growth, businesses that generate a healthy return on their capital, and ones that pay an attractive dividend yield. Once I have all of my stocks ranked, I select the top 20 stocks and put them in my portfolio at an equal weight of 5%. Then I simply hold these positions for 1 year, rebalancing every month back to the original starting 5% weight for each position. That's it. It's a simple rules-based buy and hold strategy, inspired by SCHD, but tailored to better align with my personal style of investing, focused on high-quality businesses that pay growing dividends. So far, this strategy has worked very well. The only area where it lags SCHD is in the dividend yield it offers. SCHD currently yields about 3.5%, whereas my strategy typically yields between 2 and 2.5%. For me, that's perfectly fine, since I am more concerned with my total return than the dividend yield. The first year I ran this strategy, it was slightly different. The portfolio consisted of the top 30 stocks, with a custom allocation that mimicked SCHD. But I found that the adjustments I made for the second year make this strategy much easier to implement, and they also happen to generate even better returns. I started this portfolio in November, and the past 2 Novembers have been rather good times for the market, and my strategy benefited from this as well. But I also started tracking how this strategy would have worked out had I started it during any other month. Since June of 2023, I have been pulling the best 20 stocks using the 4-factor strategy and documenting the results on my Patreon page. Thus far, launching this portfolio at the start of any month would have led to better total returns than investing in SPY or SCHD. The margin of outperformance isn't great for all months, but let me break down the results for you. The June top 20 list has thus far returned 24.66%, compared to 14.62% for SPY and 11.41% for SCHD. The July top 20 list has returned 14.09%, compared to 7.52% for SPY and 5.78% for SCHD. The August top 20 list has returned 7.79%, compared to 4.19% for SPY and 1.53% for SCHD. The September top 20 list has returned 8.99%, compared to 5.92% for SPY and 3.06% for SCHD. The October top 20 list has returned 15.15%, compared to 11.19% for SPY and 7.58% for SCHD. The November top 20 list has returned 22.55%, compared to 13.65% for SPY and 11.85% for SCHD. And the December top 20 list has returned 8.34%, compared to 4.14% for SPY and 5.22% for SCHD. The December returns are price returns only, and they will change slightly once I factor in any dividend payments during the month. SCHD will see its return increase, as the fund paid a pretty nice dividend recently, but it won't be enough to beat the 4-factor strategy that will also benefit slightly from any dividends. The top 20 stocks for January have already been selected, and the list is posted on my Patreon page for anyone that would like to follow along how the strategy is performing. The chosen stocks for January are EOG Resources, Sociedad Química y Minera de Chile, ADP, Pioneer Natural Resources, Fastnell, Paychex, Infosys, ASML Holdings, Texas Instruments, Home Depot, Old Dominion, Robert Half International, Expeditors International of Washington, Monolithic Power Systems, Microchip Technology, Masco, Watsco, Broadcom, MasterCard, and Rollins. Collectively, these 20 stocks have a forward dividend yield of 1.93%. They have increased their dividends at a rate of 21.66% during the last 5 years. They have an average return on capital of 24.65% and a 559.01% free cash flow total debt ratio. So while the yield has come down a bit here in January, given the recent run-up in the market, the goal for this strategy is on generating a strong total return while providing a growing stream of dividend income. This strategy should perform well when the market is strong, and it may underperform when the market tumbles. It's a long-term strategy that I intend to follow for many years, riding out any ups and downs in the market. The pilot portfolio that I committed to this strategy is pretty small. Currently, it has a market value of a little more than $2,400. But I have also started investing more capital into this strategy in portfolios that I don't share publicly at the time. Thus far, for fiscal year number 2, that started on November 1st, 2023, the portfolio has generated 7.92% of alpha over the S&P 500 and 9.01% of alpha over SCHD. While I don't expect every month between now and November 1st, 2024, when it's time to select new constituent stocks for the portfolio, to be strong, I do expect that it will finish ahead of the S&P and SCHD. If you'd like to follow along with this strategy, then make sure you subscribe to the channel so you don't miss future updates. And while you're at it, might as well give this video a like to help out the channel. Thank you for watching and see you next time.